How to pay yourself from your limited company. Are you overpaying in tax? If you haven't yet, click the bell and subscribe to be notified every time we produce our best pieces of content. So if you've got that nagging feeling where you think that maybe you're overpaying tax, so how to pay yourself the best way out of your limited company. Now, you get lots of advice as a business owner, don't you, from the people around you, and I'm sure they mean well, but some of the advice that you're given is out and out wrong. Another advice may be right, but just out of date. So are you taking your money out of your business in the most tax efficient way possible? Follow my video for more. Consideration number one, your personal allowance. So have you made sure that you've capitalised on your personal allowance? This means an amount of money you are allowed to earn every single year tax free. Now, one thing to bear in mind, if you don't use your personal allowance, you lose it. So make sure you are capitalising out your personal allowance every single year because this is tax free. Consideration number two, corporation tax. So when you are taking money out of your business, some strategies allow for corporation tax deduction and some are after corporation tax. So when you are looking at the strategy, make sure you are taking into account your corporation tax. Yes, I understand a limited company is a separate legal entity, but technically from a tax point of view, it's you. So if you're taking money out of the business after tax, make sure you are covering that within your calculation. At the time of this video, small company rate is 19%. So point number three is ways to pay yourself from your business. Number one is salary. Now you may have been employed in the past where your employer declares a salary for you. That means you agree a gross pay, they deduct tax and national insurance and pay you the net pay. The company pays that money over to HMRC and the net pay hits your bank account. Now, as a business owner, another thing to bear in mind is not just the effective rate you're paying on your tax and employees' national insurance, the company also needs to pay employers' national insurance. So make sure you are taking that into account when you're doing any bit of tax planning. Another way to take money out of the business is via a dividend. Now, a dividend is after corporation tax, but you can only take a dividend if there is available profit. If you haven't made a profit or your reserves on your balance sheet are negative, you cannot take a dividend because these are illegal under the Companies Act. So if you're considering dividend planning, make sure you've got the available profits to be able to take. A third way to take money out of your business is interest on your director's loan account. Now, if you're not sure what a director's loan account, check out our video. I go through exactly what's included within a director's loan account. Now, if at any point in time the company owes you via your loan account, you can charge interest on that capital. Now, in the past, we had a really low interest rate and they've been really low over the last 5 to 10 years. But now interest rates are on the up. So you are allowed to charge a commercial rate of interest. Now, I find this quite attractive because interest charged on a director's loan account, you get corporation tax relief on it, which on the current rate saves 19%. Now, personally, you're allowed to earn a banding on interest received, which is completely tax-free, and the rest is taxed at either 20 or 40%. I think this is majorly attractive for anyone that's got credit balances where the company owes you within your business. Point number four, what are your total earnings? So your total earnings are going to be really important because on your self-assessment, they're all going to be added together. So when you are taking the money out of your business in the most effective way, look at your other income. Examples of this are other interest that you've earned on deposit. Have you got any other loans that are not within an ISA that you're receiving interest on? Have you got a share portfolio that's outside of an ISA or a pension? Have you got any buy-to-let properties? These are to name a few. When you are looking at taking money out of your business, look at your total income because this could put you into another tax banding. Another way to take money out of your business is via a pension. Yes, I understand. Putting money into a pension locks it up for a period of time. But on entry, you're saving your 19% corporation tax or more if you've got bigger profits, and also your dividend tax on entry. So for nice round figures, on entry, you are saving 50% in tax. Now that is massive because this gives you an opportunity for your funds to grow and build on tax relief. Now, I think this is a big opportunity. Now, per director, you are allowed to invest £40,000 into a pension per year. So this is a big opportunity for you to take money out of your business. I get it goes via a pension, but you will allow yourself to build long-term wealth, take the money and pay the tax on it later. Point number 5 is monitor your numbers. So there has never been easier for your accounting to be prepared on almost real-time basis, or at worst monthly. So with software like QuickBooks and Xero, you can keep your finger on the pulse all the time. So you can monitor, have you got the appropriate level of salary? Is there a credit balance on my director's loan account which will allow me to charge interest? And is there profits for me to be able to take profits that I need? Now, when you are taking money out of your business, make sure you've got this covered. Do you know what you need to live on and have fun with on a monthly basis? The better clarity that you have on this monthly number, it will be easier for you to plan for tax, because you won't be constantly going, I can take that, I can take that, I can take that. You know definitively what your monthly number is to be able to take the money. And by having great accounting, you'll be able to make sure that you are able to take that with levels of profits and balances on your director's loan account. How well are you doing yours? Tax rates change. Now, if you remember back to 2022 when we had Liz Truss as our Prime Minister, the tax rates changed quite radically. And in a blink, they changed again. So all the tax rates change regardless. So make sure you've got a handle on exactly the tax rates and exactly the reliefs. So when you are extracting money out of your limited company, you are doing this in the most tax efficient way possible. The best type of planning to do is before your actual year end. And the best planning to do around tax is actually budgeting forward. So make sure that you are sitting down with your accountant or your advisor and you are planning this religiously. You are taking aboard every single relief that you can and also maximising your income. Now, if any of this has stuffled you or you've got some questions, please click my calendar link below. I'll be happy to jump on a discovery call with you. I can take aboard any questions you have, aim to give you as much value as possible, and I promise there'll be no pushy sales pitch.